Welcome to the Collecting Keys Real Estate Investing Podcast with your host, Mike DeHaan and Dan Austin. From wins, losses, horror stories, and tactics for optimizing your business, Mike and Dan take a real, uncensored deep dive into the ins and outs of running a full-time real estate investment and wholesaling business.
What's going on, guys? On this episode of the Collecting Keys Real Estate Investing Podcast, we have Pranay Parikh, who is a fellow GoBundance member with Dan and myself. And his claim to fame, as he put in the brief messages we exchanged before we hop on here, was he has bought about $200 million in real estate in the past 16 months. So those of you, wow. So like, you know, that makes, there's like, what is it on The Wolf of Wall Street, where he's like, I made $48 million last year. And that kind of pissed me off because I made, just less than $1 million a week. And, if my math's right, that's about $4 million a week or pretty close to it. So I think you beat him pretty handily there. Well, in terms of like value, right? Not necessarily in cash, but thanks for hopping on with us. So, love to hear a little bit of a brief background about you and sort of, who you are, where you're from, and how the hell you managed to buy $200 million in 16 months.
Yeah, I wish I was taking home a fraction of that. It'll come eventually. Yeah. So, when I first graduated residency, became a full-fledged doctor, I knew that I had to do something with my money. I made a good salary, but it was important where I placed it. I picked real estate. I could have picked business. I could have picked stocks, but real estate made a lot of sense to me because I've seen a lot of people do really well. So I bought a 4-unit in Los Angeles, Long Beach, actually, close to the water. Mm-hmm. And I didn't realize at the time, but it was a home run. It was doing very well. And I thought I would buy one of these a year, in 5 to 10 years, I would retire and I'd be done. Right. And after that, I spent hundreds of hours looking for my second property, and it was hard to find. I had just gotten super lucky, and, I was pretty distraught, spent all this time. I should have just been working, mm-hmm. Making mm-hmm. doctor money. Yeah. And so that's when I found passive real estate. And I found that I could get 98% of the benefit for like 2% of the work. Yeah. And so,
and so
I connected with,
sorry. And I'll say, and so I guess first off, how long ago was this where you bought the fourplex? I know you said you're a doctor. Was this like something that you did fresh out of school? Was this like 3 years ago?
Fresh out of school. Yeah.
Okay.
Yeah. Like about 5 years ago when I graduated.
Okay. Perfect. So that's a pretty quick uprise, about 5 years. And then you said you found passive real estate. Is that like, you mean just like the concept of passive real estate, or is that actually like a specific platform you're talking about?
Yeah, because I didn't know you could do that, right? I always thought that, these big apartment complexes, I thought there was some rich dude, with a monocle buying it.
Yeah. Monopoly character. Yeah.
Yeah. With his cane, and just balling out of his mind. Yeah. And I didn't realize that all these people, like normal people, right, that would do it. So I connected with my partner at the time, my business partner, who was also a doctor, and we created a course to teach doctors how to invest in this mm-hmm. stuff. Because at the time, 5 years ago, there wasn't a hands-off investor. There weren't all these books and stuff. It was just, it was like, he called it country room deals. You'd have to be part of the country club, mm-hmm. and you'd have to know someone to get you in. So we created this course. We thought we were done, but we realized that most doctors, even if they know how to do something, they don't necessarily have the time to vet, to find deals. Mm-hmm. And they were like, okay, Pranay, how do we get into deals you're investing in? And they'd be like, okay, how about we add all your money together, add all our money together. Maybe we can get better deals. That's how we really first started. And then we got to the point where we can buy the whole deal ourselves. And so that's where we are now. We do JV equity. That means we bring pretty much every single dollar other than the sponsor's skin in the game in the deal. And we have something called major decision rights. So we can buy, sell, and pretty much make any decision for the property, and, kind of throw our weight around a little bit.
Oh, interesting. Okay.
Oh, so when you say, just a point of clarification too, mm-hmm. You say JV equity, does that mean you're not actually syndicating funds? You're just doing JV partnerships with all of your investors, all your friends, so to speak.
Exactly.
Okay,
Yeah.
perfect.
Yeah. So that's a unique position that we hold because, at the end, we're still doctors, right? And I am better in the hospital, the OR, than I am in real estate, and I understand all that stuff, but I trust someone that's been doing it for 30, 40, 50 years, then I would trust myself.
Yeah.
So our skills is really managing people.
Yeah, absolutely. Yeah, that's really interesting. And I guess to just backtrack really quick too, for anyone who may not necessarily know what you're talking about who's listening. So a syndication is typically when you have a larger asset, like usually like an apartment complex or a commercial building. And the syndication is the whole process of like raising money to do so. And typically a syndication is made up of general partners or the sponsors, which are the ones that typically find the deal, manage the deal, put in all the hard work, and then they bring in what's called a limited partner, which is either individuals or funds, or in your case, like an entire JV partnership who takes up the bulk or maybe even the entire limited partnership, which will be a more passive role for typically a fixed, like either a preferred return or some sort of fixed return with like an upside based off of performance, things like that. And what that does, it allows the general partner to get into a larger deal, basically by bringing in more hustle and typically less money. And it allows the limited partners, which are typically people who want a more passive experience with that investment, to be able to get a better than average return without having to create the opportunities themselves, have the expertise, or do any of the real grunt work to get that property done. So, and if I butchered anything there too, you can feel free to correct me on anything there, Pranay. But
because most real estate people are good at real estate, and they're not necessarily good at the business of raising money. They're two separate skills. So we work with people that are really good at the real estate. Just like if you needed heart surgery, you want the heart surgeon to do it, not the belly surgeon, right? You want to, you really want it subspecialized. So that's why we're able to bring our two powers together and make it work.
Yeah.
That's great. So as a money raiser, Pranay, do you individually, do you generally get general partnership on some of the deals too? Or are you just a passive completely with the JV?
Correct. So it's very important that we are, so it's different depending on the deal. So joint venture, actually, in terms of power in the deal, you have investor override, which means you can decide. So say someone decides like, we're going to paint this yellow, and we say, no, why would you do yellow? We're going to paint it blue, right? We have power to do that. We very rarely do. I don't think we ever have, but we do have that power. You might be talking about in terms of promote. Promote is the portion of the returns that usually go to the general partner. So yes, we do get a piece of that, and we pass that to our investors.
Gotcha.
Oh, I love that. That's awesome.
Nice. So, I mean, and I love how you set this up too, because I think you're the first person that I've talked to that is like literally just building a whole business around the limited partnership side. So many people, especially in GoBundance, as you meet people, they go and try to be syndicators, right? And they try to be like a deal finder. But you've basically looked at your environment, your expertise, and said, how can I have the same involvement, without having to have all of my own capital, which would tie me up into all these deals, right? Because I imagine that your split in these, is your percentage ownership in these limited partners, these joint ventures that you do, is that directly tied to your financial contribution, or do you have higher benefit because you're operating it? Or does that question kind of make sense? So if, let's say you're raising like $50 million, do you only own 10% of it if you put in 5 million yourself, or do you own 10% of it just because you're the owner, and then you basically raise the 50 million outside of that and you work yourself into the limited partner without having to bring in your own money?
Yeah, so it depends on the deal. So a lot of times our investors will pay us a portion of their returns because of what we do.
Nice.
Yeah, so that's where the kind of the difference comes from.
Perfect.
And that's why we pass our promote directly to them, because so even though they're paying for us, they're getting extra benefit from the GP.
Yeah.
Right. Yeah. So you're creating extra value. And because you're creating extra value, you're sharing that extra value. They still get some of the extra value.
Yeah.
And then you get a piece of it for putting it all together, doing all the legwork, the sweat equity, so to speak. I like that.
Yeah.
And there's one difference that's we've kind of evolved over. So, there's a decent amount of people who do what we do, and they're called capital allocators, right? They find money and they allocate it to different deals. But we have a full asset management team, which is rare because that means there's someone that we talk to the property manager for each one of our properties every week. Every week we're talking to them. We're going to them. We're going to go look at it almost twice a quarter, sometimes every 2 weeks, to like physically go to look at the property. And we do that because we want to maximize profit. And like I said, we manage the manager, right? We're trust but verify. And that's really rare for allocators. Normally because most people make their money on the front end, right? Through fees, through all this stuff. So they'll raise the money and then go on to the next deal. But for us, it's very important that throughout the whole process that we're really keeping our investors first.
Yeah. Right. So so does that mean when you say you're basically helping manage, or you are managing the asset as you have asset management, and you made a comment that a lot of people maybe were alluding to, like the typical syndicator make their money up front through an acquisition fee of like 2%, say. So they buy a $1 million unit or property, they're getting 2% of that as acquisition fee.
Correct.
So, and typically that syndicator will also get a portion of the general partnership equity. And then on the back end, we'll get that same share of equity when the property sells for hopefully what they say it should sell for on their pro forma.
Correct.
But what I'm understanding is you're kind of taking it from a different approach. You're doing it completely from a JV standpoint, and you're acting like somewhat of a syndicator in the sense a syndicator would also manage, hopefully, an asset manager, or they would be doing the asset management itself. But you're taking on that role too.
Yeah, we took a lot of inspiration from Blackstone and Goldman Sachs, and a couple of the operators that we work with them. So what they do, they don't send their very expensive analysts, in their nice suits and leather shoes out to walk these properties, right? So what they do is they say, hey, we're going to partner with people that are boots on the ground, and we're going to take all our expertise, our efficiency, and help the system, right, the LLC improve. And that's kind of what we do. And because we work with so many people, so many different groups across the US, a lot of times we're seeing what people are doing, and we're able to take that and put it in process with a different group. For example, we were working with one group, and we were able to come up with this incentive system for the property manager, and we help them improve their occupancy from 86 to 90% in a month. Wow. That's humongous.
That's great. Yeah,
that's very big.
Wow.
So when you're going through these, are a lot of the deals that you invest in, I mean, you underwrite them, do you look at many different operators? You kind of have like the same operators you look like? Is it specific kinds of asset classes? I guess, what's your basic investing criteria that you look for as you go through this?
Yeah. So, I tell people we're simple doctors, right? So we stick to bread and butter commercial real estate. So value add multifamily, maybe a little bit of core, but only big apartment complexes. It's easy to understand. People always need a place to live. And yes, our first place that we do is we vet the operators, right? And because we're bringing in a check size of 8 to 15 million, they will open up their books. So we'll go to their current properties, see how they're doing, right? They can tell you anything that's happening, but right now it's super important to look at their properties, look at the actual numbers. Historical track records are great, but it's also historical. So we go walk the properties that they have right now. They're owning, they're operating. We have them open up the books. And so once we feel comfortable with that, then they will bring us deals. And people ask us often how we get deals. People bring them to us. I told you we had a deal we closed in August that had a 2.9% interest rate. Someone brought us that, and they said, hey, if you want this, it's yours.
Wow. Yeah, that's awesome.
Wow. And so when you say, just for our audience too, I think this would be a help for them to understand. When you say you engage with operators, what does that mean?
Yeah. So people that have syndication companies, but they are good at real estate. They've been doing it 20, 30 years, but they've just never built a robust system to raise money. And what we really like are people that they only work with institutions. So one of the companies we work for, we did a deal with them, and then the very next deal they did was for 130 million with Goldman Sachs. Yeah, and they asked us if we wanted to be co-GP, so general partners with them. We're like, yeah, sure. They're like, okay, we need $20 million, which is a little bit too much for us. But so a lot of times for these people that work in institutions, the deals we do are great and they have great yield, great returns, but they're a little bit too small for institutions. So we come in and fill that gap. And because now we've done 8 deals where we've raised, over $70 million in equity, that we have a good track record in raising money. Because it's when you work with someone and you tell them, they put their name down, right? And they say, hey, we're going to buy this, let's say $40 million property. They're putting their neck on the line, and they're anxious until we give them the money in their hands, right? So there's a lot of trust they're placing with us, and it's trust that we've built up over time.
Yeah. Right. Absolutely. Okay. And that's awesome. So you have operators that may be syndicating other deals or have other opportunities, and they're coming to you saying, hey, Pranay, we need your money. Can you give us money? And you start underwriting the deal, working with them. Right. Okay. Wow. Fascinating.
And some of them won't do a deal unless it's with us. So they'll say, because it'll probably be too small for them. Like I said, they do big, 80, 100, $200 million deals. But if we're in, then we're in,
Gotcha.
Right.
So
nice. And also you're bringing a whole system to them as well, which I think is the other selling point why you're saying they're coming to you. You're not just a bunch of wealthy doctors that are like, let's throw money at it. They're coming to you because of the value add your group is bringing outside of the money is what I'm understanding as well.
Yeah. And how I explained to other doctors, I was like, if you have one doctor, that's great. But if you have 2 doctors looking at the same patient, that's like, Cedars-Sinai, that's like UCLA, that's like really good Harvard care. Right. And that's what we bring. And they appreciate that we have a lot of expertise in maximizing profit and with our asset manager. And so you're right. We try to bring as much value as we can to them, because some of these deals, like, they're home runs and everyone knows it, right? So they can go to everyone.
Yeah. One more question on that then too is you talked about with your asset manager. Did you learn that skill and grow it in-house, or did you seek out an asset manager, and how did you go about doing that, if so?
Yeah, great question. So in the beginning, when because we're still a startup, a couple years old, you have to have everyone that's a generalist, right? And people that are willing to do whatever. And at some point, you move from generalists to specialists. And a lot of times it's sales. Like, you should hire like a salesperson that knows what he or she is doing, right? And the same can be said with the asset manager. So there's a company called Bullpen that a lot of people use to find asset managers. We didn't have a lot of great luck because they were either very expensive, but and this is one of the benefits, because we work with so many sponsors, we asked them, like, who's the best person and fortunately we were able to find someone, and literally this company that works with Goldman Sachs and Blackstone and stuff, he is the best person that we've ever worked with, and we were able to convince him to come work with us.
Nice.
Yeah, that's great. I like the comment too. It's really good for our audience, and Mike and I have felt this. When you are starting out, that you are generalist, like you do everything in the business, and then you grow a little bit and you become you're able to hire the specialist, I guess I would say, and oftentimes, and that transition is not always quite apparent, and it takes a little longer than sometimes you would like, or you allow yourself. But that's like it's such a key transition to keep growing and success. Because if you stay a generalist, you're always going to be just kind of at that level. You can't go up above it. You got to get to that point to where you're growing expertise and hiring the best people for those roles for your business to grow.
Yeah, the earlier you can hire people smarter than you, the better.
Yeah, exactly. It comes back to that concept of who, not how, right? Which is so popular amongst especially the small entrepreneur space of, if you don't know how to figure something out, instead of buying a course or figuring out, watching a bunch of YouTube videos on how to do it, go find someone who's already done it and just pay them the money. Like, you'll get there exponentially faster.
Well, and sometimes out of necessity, right? I mean, Pranay, you're a doctor, and like, that's like a pretty important job. Like you don't just get to, in the hours, we all know, like doctors, it's not like you're just clocking in. Maybe your job's different, but like 8 to 5 or whatever, like you have sometimes on call and all these things. Like out of necessity, you need to find those specialists and hire the better people, but it's also not easy because that takes time and that takes effort to go and find those people as well. So it can be done though.
Yeah, and the nice thing is what we do in real estate, it's not life or death, right? You can
Right.
you can have a failure, you know, you're probably, maybe you'll lose a little money. It's not a big deal. We had, now that we do most of the stuff in-house, but we had an army, and we can still kind of do, of people from Upwork. And you can get the most amazing people from Upwork. We, you know, while we were building up our underwriting team, we would hire people from Harvard, like masters in real estate, or working for these like multi-billion-dollar funds. And you know, it's expensive, a couple $100 an hour, but because they're working hourly, you end up actually, maybe it's like $500 to $1,000 per deal to have it underwritten, which is, I mean, that's pennies for how much you can make on a good deal.
Exactly. I mean, even for us spending, you know, $1,000, we're mostly in the residential space, but like that's perfectly fine because we're going to make, you know, hopefully 50 times more of that at least. But with yours, I mean, you're talking about 1,000 times more of that, you know, especially for looking at the whole LP. So,
and I second that Upwork piece. Is you don't, like, we get so wrapped up in thinking we need to hire and build a business based on the traditional brick and mortar model we see. Not today. The technology allows it, and there's the capacity within the workplace for people. Like you're saying, they might be $200 an hour from Harvard, but they're willing to do side work on Upwork, or maybe that's their committed job. That's what they want to do because they like the flexibility. You can find everywhere from that on Upwork, or another website, all the way down to the $3 VA that'll just clean up your inbox. That all is valuable.
Yeah, exactly. So awesome. Well, I think good transition here. I would love to dive into your whole process of raising money. Because I know that's a big thing that comes up with real estate investors who are doing any sort of scale, regardless of the asset size. And I mean, I imagine with your network, being an MD in LA, you probably have no shortage of friends that have a lot of cash. I mean, you know, occupation and location wise, there's going to be a lot of that. But so I guess, you know, you said you've raised about $70 million so far across all these deals. Is that from like, you know, you just found like the old doctors that are sitting on like 40 mil that just want to give you 20? Like, do you actually have a fundraising process? You know, what does all that look like? A, and then also B, depending on this process, how did you go about setting up the legalities of this? And I guess, do you have any tips for people that are doing that? Because that's something else that we see that's really common, especially with newer investors. They start trying to raise money, not realizing they're breaking pretty much every SEC rule that you can, where they're just like posting things on Facebook.
Posting on Facebook, looking to start a fund. It's like, I'm pretty sure that's illegal.
You can't do that. So what did that look like on your end?
Let me start with the legal part. And so I live in Los Angeles, as you mentioned. The California SEC is a lot more strict than the federal SEC, which is something that a lot of people don't know. And if you're not based in California, I hope you don't plan on having any California investors, because if you do, then they will hold you to their rules. So that's actually one of the reasons why we do joint ventures and we do co-GPs, because we don't sell securities.
Okay. Yeah,
that's very important to know. We don't sell securities, meaning we don't sell pieces of building that for an investment. We buy the whole building ourselves. You know, and so in California, for most people, if you're not a broker dealer, meaning you have passed a bunch of tests, you work for this big hedge fund, then you can't do what is called a fund of funds, which is a common way most people get started. They see a deal like ours, which is 15 million. They say, hey, let me raise 1 to 2 million for you, you know? And that is not very legal in California. So what we do is joint ventures. And that's tough. It's tough to get started. You can't do a $15 million raise. What I would do is I would just work with someone that's buying a $5 million property. There's plenty of them out there, right? 5 million, 3 million, 2 million. Just get your feet wet, right? Do it legally, because in the long run, you're going to want, because over the past couple of years, you could do it however well you want, and no one's going to care, because the only time the legal framework matters is if things go poorly. right? If someone loses money, which potentially could happen in the next couple of years with interest rates, recession, then right now you really want to have done it right. Our lawyer is $700 an hour.
Okay.
It's ridiculous.
Yeah, right.
Yeah.
So when you say doing it
he's-
legally, I guess
Yeah.
what's like the
Yeah.
number one thing that people need to be aware of, I guess, you know, because like a lot of people, they don't know what they don't know regarding that.
Yeah. So this is how we found our lawyer. We found people that have been in the business for 20 plus years. Who do you use? And it's funny when we talk to someone new, a new group, our lawyer is like, oh, who do they use? Because there's like a handful of people that do this well in the US that are very successful, you know? So there's not that many. So try to find the right, I mean, anyone's going to write you an LLC, but the reason the paperwork is so expensive is because it protects you, not them. It protects you from being sued. And that's why it's important for you to pay for it. I mean, our very first, we've paid tens of thousands of dollars for each one of our PPMs. And, you know, I'm like, okay, next one's going to be cheaper, right? And of course, we change something and it ends up being just as expensive, but it's important, and that's cost of business, right? So the thing is like, and last year, maybe about 2 years ago, all the lawyers started talking about this stuff, all the stuff I just told you about, having to be JVs, can't do in fund of funds. I was like, that's stupid. Who passed this law? But the law has always been in the books. It's just no one actually enforced it. And, you know, we had new administration, and that's kind of the problem, right? You're at their whim on what they're going to enforce. So just do it the proper way in the first place. And that's what we try to do. You know? We're always 506C, so we can talk about it everywhere, right? We don't do the 506B. Even if it's a 506, like the sponsor's 506B, we just do ours 506C. You know, we can talk about it on Facebook. We can advertise. We can do all that stuff. And it protects your butt. You know, the last thing you want, especially for any of us doing this, is the SEC. You're not going to go to jail. They're going to just be like, okay, you're done. No more financial investments, no more raising money. And then, you know, your whole career is gone.
Yeah.
Absolutely.
So I guess 506B and 506C, do you have like a too long didn't read for that to just sort of explain the difference to someone who's not sure?
Yeah. So this is just a certification that you elect to do. So you choose what type you want. And 506C is probably what you see a lot of ads for, CrowdStreet and stuff, where you can completely advertise to anyone and everyone. And the reason you can do that is you can only allow accredited investors into your deal. To become accredited, you'd have to make over $200,000 per year for 2 years in a row, or $300,000 as a couple, or have a net worth over $1 million, not including your primary home, or 3, this is actually new, you can pass a test. It's called the Series 65 or the Series 7, and that makes you FINRA approved. So FINRA is an acronym for a big financial test that you can take, and SEC follows it. So those are kind of the big ways that people get that. And so, as you can imagine, not everyone qualifies for that. 200,000 is a lot of salary, right? So fortunately, most doctors do. But for 506B, like boy, you can have up to 35 sophisticated investors. So those are people that say maybe use a tax accountant, or maybe have invested in a deal, maybe have started their own business, or as an entrepreneur. It's kind of a wishy-washy definition. But you got to have a pre-existing relationship with them. So I can't just be like, hey Dan, here's this investment deal. I know I just met you today. Do you want to invest? You know, you got to have some kind of cooking period. They say 2 weeks, 4 weeks before you introduce a deal to them, and you got to get them on the phone and show that you have some type of relationship. But it opens you up to having a lot more investors, right? You can ask your parents, you could ask your siblings. They don't necessarily have to make that much money. So 506B is a lot easier to raise money for, but 506C has a lot more legal protections, because it's not just you who certifies accreditation. You actually got to have a third party that looks through their finances and confirms for them.
Good breakdown.
Yeah. So if I could get this right from my experiences, if you're advertised and you elect to engage with somebody, because like I've had advertisements sent to me and I engage with them, they ask you first question, are you an accredited investor? Yes. And then what you're saying is this for the 506c, they're casting this broad net. If you say, no, I'm not, then it's like, sorry, we can't allow you in.
Exactly.
Say, yes, you are. Then you have a third party to hit and manage or look through to make sure you're hitting that 200 or 300K a year, or that you've passed the, I think you called it Series 65 test, or $1 million in net worth, which is not hard anymore. They might have to change that. Honestly, they might have to change that one.
Yeah, well, you have to remember that your debts go against that, right? So I don't have my net worth is way negative because I own all these rental properties, right?
Oh, I see. So they will take, does it have to be purely, so if you have more like debt than equity, that debt crosses out. Okay, that's interesting. I could see where you're saying it gets a little bit more sophisticated.
And then the difference is the 506B can't be openly advertised. So
it's that relationship.
Yeah, that's funny. I mean, it's kind of funny. I didn't realize they added that test to be an accredited investor. Like I don't know if it's like difficult test.
Well, because all these people were financial advisors, and they were like, hey, we can't afford to invest in the deals we're advertising, the SEC was like, okay, that's reasonable. And if you work for a company, like our employees are able to invest in our deals because they, they're considered knowledgeable. So there's a couple loopholes, but for most people, it's a 506B or 506C.
Yeah. Okay.
So now you talked also about getting a lawyer, and you mentioned PPM, which is private placement memorandum, right?
Correct. Yeah. So
you're getting that set up.
Yeah, it's kind of the paperwork. It's what people sign and ignore and not read, but sign that they've read it, saying that like, and it's bad. Like if you read one, you're like, yeah, there could be a flood, there could be a tornado, aliens can come. It's basically giving them every bad thing that could happen to the property, just so they can't come back and say, hey, they didn't tell us that aliens can come and destroy this property. Like we want our money back.
Yeah, right.
Yeah, exactly. No, I totally get that. But you're paying a lawyer to make sure that's very well crafted to protect you. And then I'm assuming the same lawyer, what I've always heard the term is SEC lawyer, somebody that has securities background, is the one that's going to help you get that 506C or 506B designation. Is that correct?
Correct. In the 506C, it takes a lot more paperwork. So it's a $10,000 to $20,000 more expensive. And, when you're just starting, 10 to 20 grand is a lot of money.
It's a good chunk of change.
It takes a while. Once you get a couple of exits, you have more cash to spend, but it is an upfront cost, but I'd highly recommend doing it properly the first way.
Absolutely. Gotcha. Yeah. Real estate is a pay to play business, as much as there's so many people out there just saying, use other people's money, do all this stuff. Just the legalities of getting going. I mean, you gotta, especially if you want to do big deals, you gotta have the money to, build the framework. Right. Perfect. Well, thanks for breaking down the legal side of it. So the actual money raising, what does that look like? Do you have like a strategy for it? There must be some process you have there for raising that much money.
Yeah. So, before you get started, I'd recommend trying to create an audience, and that's kind of true for no matter what you do. So my partner, Dr. Peter Kim, he created this brand called Passive Income MD that it was a blog, a podcast. We've done conferences, and he created an audience of doctors. And that's way before we had a company that raised money. And so it was a natural for them to want to invest in us because they trusted us. We've talked to them, we've met them, got on the phone with them for years, right? So that's how we're able to do it in a pretty lean way, because we already have a media company. If we had to build from scratch, we would have to rely on other people's audiences. That's what I'd probably do, kind of like what I'm doing right now, jump on other people's podcasts, talk about it, and that's how I would build up an audience. But this is a borrowed audience, right? You got to find a way to bring it back to yourself.
Yeah, exactly. Yeah, I mean, that's huge. I mean, that's a big reason we started this as well, is to start building that audience, because especially when there's so many people out there that are doing similar stuff or trying to raise money for their syndications or their funds or whatever, if you have a little bit more credibility, I mean, it's the same way that like Brandon Turner has been able to raise so much money, Coast of Old Coast, Bigger Pockets. Sure. He raised 50 million in like a week. And like just being able to do that strictly off of Instagram as well, just purely because of the following that he built.
He was actually at our conference a couple of weeks ago.
Nice. Which conference was that?
Yeah.
It's called financial independence through real estate for doctors.
Oh, sweet. Yeah. Perfect.
It's in LA. Yeah. He was our keynote speaker.
Nice. Very cool. That's awesome. Yeah. But yeah, I mean, that's super valuable point. So I guess, as you're going through your raises, is a lot of people that invest with you, they're also doctors, I'm guessing, because that's who's the main audience. Are these people that you kind of know through your direct network? How much of that is like cold, where you're having to like sell them the deal? What does all that look like?
I'd probably say 80% warm. Okay. Like we actually just hired a IR person to start calling people and texting them to tell them about our deal, because otherwise we've sent a couple emails out and we're full. So we're pretty fortunate in that sense. I think those days are gone. We're no Brandon Turner, but I think even talking to him, he's having difficulty, and his email list is like 20,000, which is crazy. Of accredited investors, right? So I think gone are the days that you can just be like, hey, I have this deal available, and just have triple. One of our deals we did last fall before everything, I think we were like 4x oversubscribed in like a week. But I think those days are kind of gone.
Yeah, especially as the market,
people aren't as willy-nilly.
Exactly. The market starts to tighten up, people get a little bit tighter. We've even found that, because we do a lot of residential wholesale, and finding buyers for properties has gotten significantly more challenging. I think it's because it's probably exists across the syndication side and the flipping residential side where we're at. A lot of like the mom and pops, the sort of casual investors, probably holding it a little bit tighter to the chest because they don't rely on that to make ends meet. Whereas, a lot of the professionals, they're willing to take some more risks and, a little bit more sophisticated and educated to make those decisions and take some risks.
You're fighting versus inertia, right? Before it was like, okay, you're trying to convince them to invest in stocks and bonds. I mean, stocks and bonds are down 25%, so it should be easy, but people are scared for good reason. And so they're like, even if I'm losing 10%, I'm going to keep it under my pillow because I don't know if I'll lose my job.
Yep. Yeah, exactly. Yeah.
Right. Or they're waiting for a better buy opportunity.
I mean, realistic thing is they're all waiting for it to top out again, as soon as their hairdresser starts telling them about the crypto or the house that they're flipping or whatever, then they'll all jump back in again.
Exactly.
Exactly. So, cool. So for the last couple minutes here, I would love to have you talk about the other stuff that you're working on. I know you said you have your own podcast. You just mentioned the blog that you guys run. Do you have any other deals that you're raising that you could potentially talk about right now?
So we have a current deal that we're raising, which we really like. It's 120 units, which is a bit smaller than we normally do. But, if everything in the world changes, you got to kind of change along with it. Normally we'd buy 200 plus units, but we like this because it's 5% cash on cash day one. Our debt service coverage ratio is 1.7, which is crazy.
That's crazy.
It's a 10-year loan. So it's, we could really, we could do a cash out refi. We can sell it. We can hold on it long term. So it's pretty exciting. If people want to find out more information, it's ascentequitygroup.com/deal. DEAL.
Perfect.
So that, it's nice to know what other people are doing. I think it's really important for your investors to talk about, if you're trying to find investors right now, what they really care about is cash flow and debt service coverage ratio. So I would really focus on those two things. Other thing I'm working on, I have a podcast. It's called From MD to Entrepreneur. So kind of just chronicles my journey as being an entrepreneur. I talk to a lot of cool guests that are entrepreneurs themselves, or they work with other entrepreneurs. I just think that the world would be a better place with more physician-led businesses, and especially after all we've been through in the past couple of years. But it's helpful for a lot of professionals, but I really focus on doctors because I find that most entrepreneurs and real estate podcasts, they focus on how to be bootstrapped, right? When you have
Right.
more time than money, and I don't have a ton of money, but I have a little bit, and much more than I have time. So it's coming from the perspective, like, how do you maximize your time with your other resources?
Yeah, that's true.
Right. Well, too, and I what I also think about when you're talking about being an MD, your hourly wage, you just mentioned it, when you have more money than time, your hourly wage a lot of times, and also probably some fulfillment too, where you don't want to give up that career that you're being truly fulfilled in. I would imagine for a lot of folks, is so high that to transition to quitting that and trying to bootstrap a business just doesn't make sense, and you're not going to get it. So I love your perspective where you're saying, hey, there's a different way to build a business.
Yeah, it's entrepreneurship is one job where you leave a bad boss to find a worse boss.
Yeah, yourself. Yeah, right.
Exactly.
Yeah.
So
and I will say too, I mean, I don't know, you can comment on this too, Pranay, but from my experience with medical folks, just especially the past couple of years, there is a lot of burnout. And I've talked to a ton of doctors and like CRNAs and these sort of things who want to step away from, their career and go and get into any sort of entrepreneurship. But that salary is much more challenging to replace than the person that wants to do that like works at an office and makes $60,000 a year. So there's a lot more structure and risk, a lot more structure involved, and a lot more risk there to sort of achieve that.
Yeah, and doesn't that suck? Like, doesn't it suck that all these people that have went into something as noble as medicine, like they're feeling burnt out? Like, that sucks, right? It really
does.
And my goal is to give them the power and flexibility to really sustain in medicine. I don't want all these people to start a business and quit medicine. Yeah, I mean, a handful of people will do that, but I want them to have the ability to maybe work 2 days a week or 3 days a week or whatever is reasonable to them, so that they'll maybe practice 30, 40 years, right? We're having this brain drain where all these people that have been practicing medicine for 20, 30 years, the people that have all these skills and knowledge, that they're quitting, and we need them to train the next generation. So if I can help them in any way to sustain, to find that passion in medicine again, then, I'd consider it a win.
Yeah, absolutely. I love it. Noble cause. And that is something that's going to be very important, especially as our population ages. And now we have the second largest population, millennials all coming up right behind them. If all of a sudden we all get old and there's no doctors, it's not going to be a good time for anyone.
Yeah. So, we're not that young anymore.
I know, right?
Yeah. Millennials, we're not that young anymore.
Yeah, exactly. But awesome. Well, thanks so much, Pranay. We appreciate you hopping on. Do you have any other last minute tips for anybody that's listening who might want to do what you're doing or get into syndications or do anything similar?
Yeah. If you're like me, you're probably like, okay, you want to hear about a book, you want to hear about a course, you want to hear about a conference for me to tell you, but just get started. I promise, like, in 1 to 2 books, you could learn 80% of real estate. That's true. 80% of real estate. And the last 20%, the part that differentiates you from everyone, you got to just trial and error. Brandon Turner, his story is so amazing because he started when he's like early 20s. He just got started. He would do all his own renovations and all that stuff, and the reason now he's worth almost $1 billion is because he got started, and do you want to be worth $1 billion 5 years from now or 20 years from now? Right. So just get started. There's going to be setbacks. There's going to be failures, but the earlier you get past that, the closer you're going to be to your success.
Yeah, exactly. Perfect.
100%. Take imperfect action.
Exactly. Yeah. That's why I always, Dan and I, we always kind of hate on people a little bit who are like the book or the education junkies, but they don't actually like do anything with their business. Whereas we're like definitely the opposite. I mean, I don't know, Dan, when was the last time you actually read a book? I don't know. So probably but
I've learned a lot about stuff.
Exactly.
Myself.
From having conversations, I've read the, cliff notes of books and get the general idea, but we've definitely done a lot of deals over the last few months, despite not reading anything. So we'll be okay.
Yeah. When it comes to technical growth, it's all about just imperfect action, doing it, try again.
Exactly.
Yeah. And when you run into something, you're like, okay, I don't know anything about replacing roofs. Like, let me go read this chapter in the book, not the whole book. Right. Now that I actually need it.
Exactly.
Right. Yeah. Absolutely.
Perfect. Awesome. Well, thanks again, Pranay, for hopping on. We really appreciate it. And thanks so much for listening, everybody. If you could go and subscribe to our podcast and leave us a 5-star review, that would be amazing. And go ahead and share this with anyone who might want to know how to start raising money or buying really big deals like Pranay has. And aside from that, everybody, thanks so much, and talk to you all next week.
Thanks for listening. Please leave us a review on iTunes or wherever you get your podcasts. And check us out at collectingkeyspodcast.com for tips and guides on starting your own real estate investment and wholesaling business.